What are your next steps? Yeah, that's what we call it at the Financial Enhancement Group, the Next Steps program. When you come in, we want to make sure that we're able to sit down and provide value for you. If you bring in the documents we request, we'll give you 90 minutes of our time, complimentary. We will go over things you need to consider today, things you're going to probably want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. Get signed up for your Next Steps meeting. You've got nothing to lose. Go to yourlifeafterwork.com or call us at 800-928-4001. Should you cancel your life insurance policy? There are many things you consider when you look at a life insurance policy, things you should consider before you buy it, things you can consider when you make the premium payment, and things to consider before you cancel it. We're going to discuss that on the next 12 minutes of Your Retirement Playbook. Life insurance is an interesting thing. They call it permanent. And yet the average person who buys a permanent policy buys 7 of them over the course of their lifetime. In fact, the people who buy permanent life insurance, you still have less than 1 in 5 people who die with one of those policies in force. So what in the world happened? How in the world could I buy a permanent insurance policy and die with no policy? And if I bought a permanent policy, how did I go through 7 of them? Well, it's an interesting thing. I'm going to actually, without a whiteboard, try to teach you a little bit about life insurance. Now, the first thing you need to understand is all life insurance is term insurance. It's what's called ART, annual renewable term. So every year, I'm 55 this year, every year there is a life expectancy table. And that life expectancy table is going to say at 55, and they're not just talking about Joe Clark of Anderson, Indiana, they're talking about all of the people that are 55 in the United States of America, and many times even more than that. But they're looking at all of the people that are 55 and saying, based on what we know, this is the probability of when your life will end. And, you know, it could be 84 and 4 months. Let's just call it 84 and a half, just for giggles, right? So at 84 and a half, the average 55-year-old in the United States is going to die. What does average mean? Average does not mean 50% necessarily, but it means that there's going to be some people, that I'm one of them. It means some people are going to die before that at 55, or they're going to die at 58, or they're 65, and there's going to be some of those folks that live to be 100. But when you look at all of those and you average them together, the average one of us, if the actuarial tables were right, are going to pass away at 84 and a half. Now, it is very, very important that you understand on your financial journey, you are unique. Right? So when you look at life expectancy tables, whether it's Social Security or life insurance, you're competing with people who were, by definition, not necessarily at dentist every 6 months like you probably were, had access to health care like you probably did, and did things that were not normally harmful for your body for an extended period of time. But nonetheless, at 55, there is a cost of insurance for me today. Now, the insurance companies will go in and will add an extra expense to that if you have bad health problems or what they call pre-existing conditions. If you have it at work, there is no extra charge because it's a group policy. What does that mean? Well, if it's a group policy, usually 1 times your annual income up to $50,000 is free. It's a group policy. So if you're in bad health, that's a good deal for you because they put it all together. Again, its own little actuarial pool. But if you're in great health, always take the free insurance your employer provides. But the chances are you can probably buy annual renewable term or a term insurance policy cheaper in your own name than you would in the other. So term is not permanent. But term is part of every life insurance policy. That's how it is priced. The rest of it is how it's packaged and how it's sold. So you can buy annual renewable term insurance where the price of the term insurance literally goes up every year because you're closer to life expectancy. It's one of those things most of us don't want to try out, quite frankly. You know, I'll keep paying the term cost. Barb and my family are protected. The Financial Enhancement Group's protected. I hope we don't need it and that I'm wasting the premium payment. I tend to buy my life insurance in 10-year increments, or what's called 10-year term insurance. I don't see the point in buying 20. I don't know what the next 5-year holds for the tax code or things that are going on. I want to buy something that gives me the next 10 years of a forecast of an idea that's what's coming. And every 3 years, I adjust. As long as my health stays in the same procedure or the same area, I'm able to buy another 10-year term policy going forward. If, however, my health were to decline, I can convert that to a permanent policy if I so choose. But I look at it in 10-year increments, not 20 years. If you buy it in 20 years, it's going to be the same premium for 20 years, but you're going to pay more the first 10 than you would if you just bought a 10-year level term policy. Now, why in the world do people go through so many different policies? And the answer really is because insurance policies are usually sold rather than bought. Now, what's that mean? Well, rarely does somebody call up a life insurance agent and say, hey, I'm in the market to buy $500,000 worth of whole life insurance. Would you like to come sell it to me? No, that's not what happens. Usually it's somebody who says, hey, I know this person, they referred me to you. I'd like to stop by and drop off a little information. And they sit down at your kitchen table and explain to you why you need to buy life insurance to protect your family from the unexpected. I get it. I understand it. It's a necessary thing, but you have to understand the difference between sold and bought. And you've got a very, very complicated thing that is working in front of you. So let's just pretend that you've got a whole life insurance policy. That is made up of what's called a face amount, if you will. That's the death benefit. And then you've got a column that's the guaranteed cash value. Now, you can always trade the death benefit for the guaranteed cash value, or you can die. You're going to lose the guaranteed cash value, but your family's going to get the death benefit. You never get both of those columns in a whole life policy. You get one or the other. Guaranteed cash value or the death benefit. This is what the insurance company is willing to pay you back, the guaranteed cash value, to buy your face amount and to eliminate their liability for your death benefit. Then there's a third column, and that is one of two things. It's either dividends, which have been defined, by the way, as a return of overcharged premiums. That's why a dividend from a life insurance policy is not taxable, or a dividend from a stock is taxable. A dividend from a life insurance policy is not taxable. However, the interest earned on those dividends after they're paid is taxable. So you will get a 1099 from your life insurance provider if you have dividends that have been paid. And the 1099 is not on the dividend, but it's on the interest that you've earned. So that cash value is building. So remember, you get the face amount, the death benefit, or the guaranteed cash value, but you always get the dividends. Those are yours. Now, you have the ability to trade those in, if you like, for what's called a paid-up edition. PUA, you may see on your statement. Paid-up edition means you bought more life insurance, so it's not a dividend anymore. It's not earning interest, and you won't get a 1099. It still has a cash value, but that cash value will be lesser than what a dividend would be if you had dividends accumulating. But your death benefit will rise. So if you truly want it as a death benefit policy, and you don't want to pay taxes along the way, and you're buying a whole life contract, you probably want the paid up additions. If you want more cash accumulation, or what they call a vanishing premium, then you're going to want to use dividends. So what in the world is the vanishing premium? And this is how insurance policies are sold. Based on our forecast today, they get this nice little printout that talks about interest rates that we're not earning today, we didn't earn yesterday, but people somehow or another think we're going to be here tomorrow. But based on the dividend forecast and current interest rates, in 12 years, you will have enough dividends that the dividend will be able to pay your annual premium, and you can quit paying premiums. That's what when people talk about a vanishing premium or a policy paid off. Very rarely is that real, by the way, a policy being paid off. It's almost always where the dividend or the growth on the dividends is enough to allegedly pay the premium into the future. It does happen. Sometimes it happens later than what's anticipated, but it typically does happen. So along the way, the insurance agent, when they sell a life insurance policy, gets paid the extreme majority of their money to sell you the policy up front. They get a little bit of money, a trickle, what they call renewals, that comes in from the policy that's there. So you expect and deserve, in our opinion, that's why the Financial Enhancement Group has its policy in terms of doing family updates on an annual basis. When you look at that life insurance policy, you anticipate that they're going to come back, visit, and do for you a review of your insurance existing policies and needs. The problem is the agent is not getting paid to be there other than the renewals they would get whether they showed up or not. So it's in their best interest to actually be able to talk to new people or to get you to buy a new policy. And this is why people wind up with 7 different policies. It's very normal for an insurance agent to look at those dividends that's inside of the policy. And please don't, all life insurance agents are not evil people. They're not bad people. Sometimes there's reasons to do this. You just need to understand what it is you're trading or giving up in order to do it. But many times they will look at that dividend or the cash value that's in there and show you how to take it to be able to use along with the premium payment that you're currently making, or maybe even get rid of the premium and buy a policy where you can take that money and put it in a large lump sum. If they start using terminology called a 1035, that's a tax exchange, where you can move money from here to here without paying any taxes or recognizing any taxes. That could be one of the things that are happening. And in my opinion, in experience, that's why we see so many people wind up with so many policies. Please do not take this as life insurance agents are bad people, or that there's never a reason to do this. Sometimes there are. I just want you to be educated and understand what's transpiring inside of there. You should never cancel a life insurance policy without making a phone call. My team is very, very well aware of this. You always want to know what the basis is inside of the life insurance policy. The basis is typically the premiums that you've paid over the years, less any money that you may have pulled out or borrowed out or whatever. It's critical to understand that because you will get a 1099 if you have a gain in it. And that money that comes out of a life insurance policy, once it's surrendered, once you've canceled it, is taxed at your marginal rate. So we've seen people that have $100,000, $200,000, $300,000 of marginal gain. They canceled a policy. They didn't think they needed it anymore. They didn't talk to their CPA. They got bad advice, a host of different reasons. They cancel the policy. Here comes the 1099, and there's no way to put that jack back in the box. It's done once it is done. So you always want to ask the questions. Again, I would tell you to bring up the filter. First, look at your financial journey, and then you want to talk about risk and volatility, fees and expenses, taxes today and tomorrow, and real return. Does this life insurance policy make sense for you, or does it not? Lots of questions. Of course, we have a checklist if you want it at yourlifeafterwork.com, or call us at 800-928-4001.